Welcome, and thanks for joining us for the first of three sessions to help you develop your financial literacy. During this session, we'll discuss how you can create a roadmap to financial success. Feel free to pause this video whenever you need to so that you can take notes. There will be a knowledge check at the end of this session, so your notes may come in handy. Let's begin. A successful journey requires a destination, a clear understanding of where you want to go. To get there, you need a map to help you navigate from where you are to where you are going. A financial roadmap is similar. It helps you navigate towards a brighter financial future. There are several important concepts that you must understand when creating your roadmap to financial success. Having a roadmap can also help you weather unexpected emergencies. Let us take a moment to discuss some of those concepts. Money is used to pay for goods and services, as well as to repay debts owed to people or organizations. Regardless of how much money we have, we must understand how to manage it when it is in our possession. Some people keep their money at home in what they consider safe places. This may be okay for small sums of money. However, keeping your money in a bank or credit union ensures that it is safe from theft or fire. A bank serves many purposes. One thing that a bank does is accepts deposits from customers. A deposit is money that you put into account that you have at a bank. This account may be a savings or a checking account. A savings account is an account that you use to save your money for an extended period. Let's say that it is November and you want to put some money away every month until you have enough to buy a gift for a relative's birthday in June. You can make a deposit into a savings account each month until you have saved enough money to buy the gift. When June comes around, you can go to the bank and withdraw or take money out of your savings account to purchase the gift. With a basic savings account, you can withdraw the amount of money that you have saved with no fees if you abide by the rules of your bank. In fact, you may have earned some money called interest for saving your money as long as you did. Congratulations. Another account that you can open at a bank is a checking account. A checking account is a type of bank account that is used to hold your money for the short term. You may need to use the money you put into this account to pay bills, buy gas or groceries, or cover other expenses that you may have. Having a checking account is helpful because today, fewer and fewer companies accept cash as a form of payment. A checking account allows you to withdraw money from your account using checks or a debit card. If you don't have a checking account to pay your bills, it's okay. You can also use money orders. A money order is a small piece of paper that's similar to a check that allows the person or company listed on it to receive a specified amount of cash. Money orders are widely available and cheap to buy. They are a safer way to pay a bill or make a big purchase than paying with cash. It is also guaranteed to be paid. For example, if someone gives you a money order worth $50, it's as good as cash once you've deposited it at your bank or take it to a location that will exchange the money order for cash. If you have never used a money order before, Let's review the proper steps in completing one. Start by buying a money order for the desired amount. Make sure the amount you paid and the amount printed on the money order are the same. Fill in the "Pay exactly to the order of" line immediately. This is where you write the name of the person or business the money order is going to. You will need to identify what the money order is for on your money order. The person or company you're sending the money order to should tell you what they want you to write here. Often, it's your account number. Place this information on the "Payment for Account Number" line or the memo line. In the purchaser's address area, you should put your name and address in this area. Make sure you write clearly so that it can be easily read. On some money orders, you may have a separate line for your name and address. If so, make sure you fill in those lines with the requested information. Sign the front of the money order. On the front of some money orders, there will be a line labeled "Purchaser's Signature," "Purchaser," "Sign for Drawer," or "Signature." Sign on this line using the full signature. Keep the receipt of your money order. Either your money order will have a carbon copy underneath or a portion attached that you can tear off and keep for your records. If your receipt is one that you can tear off, make sure you add who your money order was payable to in case you need it in the future. Be mindful you should not sign on the line on the back of the money order. The signature line on the back of the money order is for the other person or company to sign or fill in before they cash it. If you have a savings or checking account, you may also use an ATM or debit card to make deposits and withdraw money from your account without going into a bank location and talking to a teller. An ATM card is a card that is issued by your bank, which allows you to access your money using an automated teller machine or ATM. A personal identification number or PIN is required for you to access your money at an ATM. It is usually only 4 digits long. It's a numeric password used to validate that you are the person who should be accessing your bank account information. Therefore, you should never share your PIN with anyone. A debit card is like an ATM card, but you can also make purchases from stores by swiping your card and or inserting your PIN. You can also pay for purchases online by typing in the numbers on the card. The numbers on the debit card are associated with your checking account number. When you swipe your card or entered your card number online, your bank knows to withdraw that money from your checking account immediately to pay the company for your purchase. When paying for purchases online, it will be helpful to understand what information your debit card, the website, is requesting. The card number is the 13 to 19-digit number on the front or back of the card. The expiration date, which may be printed on the front or the back of the card, is the last date that your card will be valid. For example, if your expiration date is 2/23, this means that on March 1st, 2023, your card will no longer be valid and transactions that you make will be declined. You will need to obtain a new card from your bank prior to the expiration date. The card verification value, or CVV, or CVV2 number is the 3 to 4 digit number on the front or back of the card. The number is used to help reduce the chance that someone who does not have your card in their possession can make unauthorized purchases using your debit card. It is important that you keep up with your card at all times. Do not give your card to others to hold for you. If you lose your card, call the bank immediately to let them know. Sometimes companies will suggest that you set up an automatic payment to pay your bills. An automatic payment is a money transfer from your bank to the company's bank that is scheduled for a certain date. You can also set up a recurring payment for bills that you pay every month. You should be cautious about setting up automatic payments because they may be difficult to cancel or change. Let us say you have car trouble and you have to pay an unexpected car repair bill with the money you have in your checking account. If you have an automatic payment scheduled to debit or be withdrawn from your account the next day, you will likely not be able to cancel or reschedule that payment. If the transaction is sent to your bank and the bank recognizes that you do not have the funds in your checking account, they may charge a fee. The company you plan to pay may also charge you a fee for your payment being rejected. It is important to ensure that you keep track of your deposits, the money you put into your account, and your withdrawals, the money you take out of your account. The last thing you want to do is overdraw your account. Overdrawing your account means that you spent more money than you had in your account to cover a charge or purchase. Overdrawing your account usually results in your bank charging you a fee due to insufficient funds. You may be charged a fee for each transaction or charge that came in to be paid when you did not have enough money in your account. These fees are high because the bank wants to discourage you from overdrawing your account in the future. Also, if the bank paid for your transaction, they loan you the money temporarily that you must pay back. If you did not have enough money in your account and the bank chose not to pay the transaction, you may receive a message that your transaction was declined. Online banking, also known as internet banking or web banking, is a great way to monitor your account to ensure that you did not overdraw your account. If your bank allows, you may also use your online banking service to conduct a range of other financial transactions through the financial institution's website, such as paying your bills through your bank's website. When you bank online, you are required to create an account. You must create a username and password to gain access to the website. This helps to keep your banking information safe and helps prevent identity theft. There are benefits to having a checking and savings account at a bank or a credit union, many of whom offer accounts for no fees or a small fee for each month. These benefits include direct deposit and insurance. One of the major benefits of having a checking and savings account at a bank is that you get a direct deposit of your paycheck from your employer. A direct deposit is a payment option where your funds are electronically transferred to your checking or savings account. This allows you to receive your payment faster because you don't have to take a paper check to the bank to deposit or cash or pay fees to a third party, such as a check cashing company, to cash your check. It also keeps your money safely in a bank so you don't have to worry about losing it or it being stolen. Another benefit is that almost all banks and credit unions are insured. This means that if an insured bank closes for good, the Federal Deposit Insurance Corporation, FDIC, will reimburse for money that you had in the bank up to $250,000. If your checking or savings account are held at a credit union, the National Credit Union Administration will reimburse you up to the same amount. If your home was in a fire or someone broke into your home, you may not be able to recover any cash that you had stored away. Storing your money in an account adds a higher level of safety and security. Now that you have the basic understanding and have been introduced to financial and banking concepts, let's talk about how you can manage your money through budgeting. Budgeting helps you to create a money flow, save, and prevent overdrafts. When you budget, you track your income and your expenses. When you are working, you receive a paycheck. Your paycheck usually shows your gross income and your net income. Let's discuss the difference between the two. Gross income is the total amount of money you have earned before taxes and deductions have been taken out. An example of this would be if you made $10 an hour and worked 40 hours a week, your gross income is then $400 for that week. Net income is your take home pay after taxes, other deductions have been taken out. For example, state taxes, federal taxes, pension, Medicare, Social Security, medical, dental, etc. An example of this would be that once your deductions have been taken out, the $400 in gross income minus the taxes and deductions would then become your final take home amount. For example, $400 minus $130, taxes and deductions, equals $270. As you consider your gross and net income and your expenses, you can begin to budget your money. Some examples of these expenses might include the following. Included in your vital expenses are housing. Housing expenses include bills like rent or mortgage. Transportation. Transportation expenses include taxi fare, the cost for access a ride, and metro payments. Groceries. Utility bills. These include your electric, cell phone, and cable bills. And healthcare bills. These include things like payment to your medical, dental, and vision providers or prescriptions. Included in your non-vital expenses are personal spending, for example, recreation, dining out, entertainment, and miscellaneous non-vital expenses. You may have regular or frequent expenses. These expenses include all of your expenses that must be paid every week, every 2 weeks, every month, or every year. These include expenses like rent, car fare, metro payments, etc. Write these expenses down so that you remember the regular expenses you must pay. Also, decide when you need to pay them each month. For example, some bills need to be paid by the 1st, the 15th, or the last day of the month. An example of a monthly expense is rent. Other expenses need to be paid weekly. An example of a weekly expense is groceries. When tracking expenses, it is important to track them at a minimum on a weekly basis. This will prevent you from overspending. While some people use different apps to manage their expenses, you really don't need any special apps or other tools. You can manage your expenses by simply using pen and paper. Regardless of whether you keep your money in a bank or in your pocket, you can track your expenses by doing the following. Keep a pen and a piece of paper with you in your wallet or purse. Write how much money you received this week. Refer to your list of regular expenses and determine which ones you need to pay this week to ensure your payments are received on time. Subtract the amount of the expenses. For example, rent, cell phone, groceries, electricity. The amount left is the amount you have left over for non-vital expenses. However, it will be better for you to save this extra money in case you need it for an emergency. And pay those bills that you subtracted from that money that you received this week. One of the most difficult and most important tasks in managing your money is budgeting for savings. Short term or cash savings through your bank savings account services is one way to save money. These savings accounts generally have no penalty to access. Long term saving is money that you put away that you do not touch unless there is an emergency. It is important to know that some institutions may charge a small service fee monthly if you do not meet certain requirements for that month. An example, some banks charge a fee if you do not have a certain amount of money in your savings account at the time they review your account each month. If you know that you will not have the required amount in your account each month, you should find another bank that would not charge a fee. Also, you may be charged a fee for taking money out of the savings account too many times per month or before a certain amount of time has passed. Remember, money in a savings account is to be saved. Leave the money in the savings account to avoid these fees and possibly the bank closing your account. There are a couple of other types of savings that you can include in your budget. These include big purchase savings and emergency savings. With big purchase savings, you may have large purchases planned. Some examples of these are vacations, holiday shopping, leisure expenses such as game systems or other electronics. Any amount of money you save can lead to your next big purchase. An emergency fund is money set aside to cover any unexpected financial surprises life throws your way. It is recommended that you have at least 3 to 6 months of income saved in a bank in case of an emergency, such as a loss of job or a natural disaster. For example, a flash flood or Con Ed outage. At some point in mostly everyone's life, money can get tight. However, it is important to prepare for those situations. At the top of your list should be the essentials, your rent payment, primarily so that you know that you have somewhere to live. Next, your focus should be on utilities, groceries, etc. Finally, you should focus on your work-related expenses or any obligations you have. These include expenses like your cell phone bill. Some ways to economize: eliminate unnecessary costs, reduce larger expenses, set aside where you want your money to go, set savings goals, and you should also consider how much money you can spend on entertainment, for example, eating out, going to the movies, cable, Netflix, or other streaming subscriptions. Ask yourself, do I want it or do I need it? If the answer is that you want it, take the time to prepare your lunches at home, limit your movie outings or purchases, and cancel your streaming services. Congratulations, you have completed session 1 of 3. Now it's time to check your knowledge. After exiting this video, please proceed to knowledge check number 1. Don't forget, you must watch all 3 videos and complete all 3 knowledge checks to receive your certificate of completion. You're welcome to revisit this video at any time. This training was brought to you by the Harlem Independent Living Center Incorporated, the Mahogany Group, Green Canvas Productions, Diagonal Media, the Financial Education Network, and we'd like to thank Kathleen D. Taylor, LLC, Certified ASL Interpreter, for this session's sign language interpretation.